ULTY is curb stomping the SPY. I know, it's only 6 months. I understand that. I'm excited not so much that ULTY is beating the SPY, but it's more about why ULTY is beating the SPY. ULTY uses put options to hedge out large swaths of the potential downside of the stock investments. ULTY's game plan is to choose the most aggressively bullish but also risky stocks to sell options on. The good news is those options bring in a ton of money. But the bad news is the stocks they sell those options on are really volatile. Those stocks, the prices of those stocks are subject to go down as fast as they go up, if not faster. Jay Pestrichelli, the head trader from Tidal Financial, solved the problem partially with options. Around mid-October, after much begging from me and the rest of the high yield community, Jay implemented a plan to hedge ULTY stock with put option callers. These put options cannot hedge out all the downside, but because there's no such thing as free money, they can hedge out a good deal of the downside. Also, these put options have a cost, and the cost is you get a little less yield. Yeah, you heard me right. Less yield on a stock that's yielding 100%. This thing would yield 150 were it not for the put spreads. I'm serious, maybe more. It's only running around 80 or 90, maybe 100, because there's no such thing as free money. And those puts the Jay buys for protection are expensive. They are so worth it, though, as you can see from this chart. The blue line is ULTY. The middle of the chart is mid-October, and that is when this thing took off. This is a 6-month chart. And to be fair, on the left of the chart, I cut it off by mistake. But ULTY was down the most during that pullback. But on the left of the chart, that's also before the strategy changed. So it's pretty impressive if you think about this. This ETF went from being down the most, that's a 6-month chart. So in 5 months, it went from being down the most to being up the most, and not by a little bit. The difference between 13 and 19 is 6, and 6 is a percentage of 13 is 45 or something, so it's pretty nice little move. Pretty nice little, pretty big little difference there. But you can see it was around mid-October, it separated itself from the rest of the pack, and it just hasn't come back. The put options are expensive. That's why it's only yielding 80 or 90, like I say, but they are so worth it. This ETF, no ETF for that matter, is for everyone. This thing is volatile. You did hear me tell Jay it has a beta weighted alpha at 5, right? That means it's 5 times as volatile or as risky as a SPY. All of these high yield ETFs are risky and volatile, but ULTY is particularly so. Proceed with caution on any of these. Discretion is the better part of valor, like my mom used to always say. No more than 20% of your portfolio should be allocated in these. Preferably use 4 or 5 of these to make up that 20% allocation. If you're one of these guys that likes to get paid all the time, you can choose ETFs to pay during different weeks in the month, or there's a lot of weekly paying ETFs nowadays. The 60-40 may be dead, but it's still better than all-in my opinion. All-in is not a strategy, also in my opinion, my experience. I say in the old days, 60 stocks, 40 bonds, or generally fixed income. So I say 60, 20, 20. So 60 stocks, 20 high yield. And so maybe 20 in government bonds, or maybe municipal bonds if you're in the higher tax brackets. You could also use REITs for fixed income type investments. Those are real estate investment trust. You can also use closed-end funds. The book Income Factory is a great book on closed-end funds, but those can be good yielders in retirement. Covered call strategies are not the only show in town. Also, a lot of folks use solutions like XPay, which doesn't even use options, but that can also provide you a tax-efficient retirement income. That fund's from Roundhill. So even from within your fixed income portfolio, stay diverse. You have choices. It doesn't all have to be high yield. You can have some REITs, some high yield, and some municipal bonds. Stay diverse. The most important rule is these are best used for income. If you don't actually need the income, there's usually better solutions, such as buying and holding good stocks. Covered call ETFs are not tax efficient and not a great way to build wealth. But if you already have a little wealth, you are able to trade part of the wealth that you have in for a little income in the form of these high yield funds. But remember, there's no free lunch. Even these high yield funds that look like they don't have any NAV depletion really do. Everything does to different degrees. To one degree or another, that is what you're doing when you use any income producing investment. You have to trade wealth to get it. If you want to buy a rental property for income, you're going to have to come up with the down payment. There's no free lunch. If you are going to go buy bonds for retirement income, those are guaranteed government bonds or municipal bonds. Great way to get retirement income, but you're going to have to sell stocks or you're going to have to move money out of something else to put into the bonds. Even if you start a business in retirement, let's say you're going to become a fishing guide, you're going to need the money for the down payment on the boat and the equipment. It's the same with these high yield ETFs. You're going to have to sell or move assets around from stocks for growth, or maybe even out of your business to put it in high yield. That's the NAV erosion. It's not the fund's fault that you need an income. The fund will just do what it's supposed to do, and that is produce an income for you, regardless of what happens to the NAV of the ETF. These are income funds, and that's why they're best used for income. So knowing all these risks and being aware of all this potential downside, that's why I always say only 20%. Really, the wealthier you are, the less of these assets you actually need to, are able to put in high yield. If you have 5 million in assets and you want 100K retirement income before taxes, you could easily get away with only having 10% in fixed income assets like high yield funds and closed end funds, and you could leave 90% to grow. That is why the rich always get richer. It's because they have extra money that can compound. It's that simple. If you're trying to retire with 500K and pay yourself 100K, yeah, that's great. And you can do it nowadays with these high yield funds, but you're going to have to allocate a large percentage of your portfolio to the high yield ETFs. Instead of 60-40, you're going to be more like 20-80. Therefore, sacrificing future growth. That's the only difference between the guy that has 5 billion and the guy that has 500,000. It's how much they have left over to invest and to let compound. The guy with 5 million has a huge head start, obviously, but they can both build wealth. You heard what Warren Buffett said was the 8th wonder of the world, right? It wasn't high yield ETFs. It was compound interest. You guys have a great day.